Hello, hello. Welcome back to another YouTube video. Today I want to cover the real strategy because a bunch of people have been asking me what the real strategy is. There's many resources out there, of course, but I'm going to break it down in a more simple manner. Of course, you can always Google research or use ChatGPT if you need to get a better understanding, right? But essentially, it is going to be a strategy without timing the market. It's not about day trading, and most importantly, it's not a get rich scheme. Okay. So what is the wheel, right? The wheel is basically a repeating three steps process. What you do is you sell a cash secured put, you maybe get assigned the stock, then you sell a covered call until the stock gets caught away. Then you basically repeat, rinse and repeat, right? So the goal is very simple, is to generate consistent income from stocks that you are be happy to own, right? So you can imagine like you are getting paid rent on a house that you're already wanting to buy, right? Um, Warren Buffett and Bill Ackman, they use versions of this. Buffett, back in the days, he famously sold puts on Coca-Cola and other stocks that he wanted to own, and he collected premium. Either he bought the stock cheaper or he kept the cash, right? The reason it works is that it's because of options decay, because every option loses its value over time. When you are a seller of option, that decay works in your favor. You are the one collecting the premium and you're not paying the premium. All right, so let's start with the first step. The first step is cash secured puts, and this is where the real strategy starts. So you pick a stock that you really want to own at a price that is below the fair value, something that you believe it's a bargain, right? And then you sell a put option at that price. So what does a put option mean? It means you are giving someone the right to sell you 100 shares at your chosen price. In exchange, they will pay you a premium immediately upfront. Then there are two things that can happen. Number one is the stock stays above your strike price and the put expires worthless. You keep the premium and you basically do it again the next week, the next month, depending on your expiry date. Outcome B is where the stock drops below your price, your strike price. So in this case, you are assigned, you are obligated to buy 100 shares at your chosen price. But of course, when you collect the premium, you lower your costs. You're paying lesser than market price for a stock that you already want to buy anyway. So it's much more easier to see in terms of numbers. So let's make this concrete with Apple, right? So for example, Apple right now is trading at $220, right? You did your fair value calculation, you say, hey, the price that I will want to buy Apple is only $210 or anything below 210, right? So you believe that that is a good deal. So what you can do is you can go to the options chain and you can sell a $210 put expiring in 30 days. And you probably get, let's say, 150 per share. So that's essentially $150 that you receive upfront for one contract. And one contract is 100 shares, as I mentioned earlier. But when you do this, you need to make sure that you set aside $21,000 in cash just in case you get assigned. So that's 210 times 100 shares. So the best case is Apple stays above $210 for the next 30 days. The put expires worthless and you get to keep the $150 in premium. That's about, let's say, a 0.7% return in 30 days. If you annualize it, that's around 8.5%. Okay. So of course, this percentages can change. You can go more aggressive. You can go less aggressive, right? So the returns can definitely change, right? Because people would say, hey, 0.7% return in 30 days, that is very little. Right. I think it's really depend on your risk appetite. For me, 1% a month, it's nothing wrong with it. Okay, you can of course get more aggressive and do this on much more riskier stocks with high beta. Okay, but in this example, the worst case is you're still fine. So let's say in the worst case, Apple drops to $205. You are assigned. So you have to buy 100 shares at $210. But your cost basis is actually 208.5 because you already collected 150 premium. Okay? So you need to remember that the premium that you're collected is yours no matter what. Assignment isn't necessarily a loss, it's just the next phase of the strategy. And the next phase is basically you get to own the shares. So now being assigned is not a bad thing because you now own 100 shares at that price that you want to be, right? And the thing is, stock selection here is very critical. You need to be very comfortable with owning the stock that you sell a cash secured put on, not just for a few days, right? Even potentially for months, for weeks. If the stock keeps falling, you'll be holding it and selling calls against it until it recovers, right? So you typically want to pick quality companies, right? Blue chip stocks, ETFs, Max 7, companies with strong earnings, companies that pass the smell test, right? They pass the valuation test, they have a white mode essentially, right? So this goes to step 3, then that's covered call. So now you own the 100 shares, right? So you own the 100 shares, you want to collect premium, you want to put them to work. So what you do now is you sell a covered call. You give someone else, the buyer, the right to buy your shares at a higher price. In return, they pay you a premium. If the stock stays below your call price at expiration, the call expires worthless, right? And you keep your shares and you keep the premium. You can sell another call the next month, the next week, depending on your expiry date. If the stock rise above your call price, your call strike, sorry, your shares will get caught away at a profit you have made money on. So you basically get put premium, call premium, and stock gain. The real resets, and you go back to step number 1. So what happens is the full cycle, and let's put everything into uh the 3 steps together and watch the wheel spin through a complete example, right? So let's say in this case, again, back to using Apple, is trading at 220 days, $220, sorry. We have $21 in capital, and the goal is to generate monthly income, right? So imagine month number 1, you sell the $210 put 30-day out. Apple stays above 220, so your put expires worthless. You keep the $150. Okay, month number 2, you do the same thing. But in this scenario, you sell the 210 put, but something happened. Maybe Apple reported not so strong earnings. Maybe there's some new specific events. This time, Apple drops to, let's say, $205. Okay, since you sold the 210 put, you will need to buy 100 shares at $210. So, but you collect another $150 in premium. So your cost basis is actually 208.5. You own shares at 208.5 now. So then in the third month, Apple goes back to 210 or 211. You sell the 215 covered call. If Apple stays below 215, the call expires. You collect another $180. You go to month 4, so what happens? You sell the $215 call again. This time, Apple rallies to $218. Your share gets caught away at 215. So you collected $200 in the premium plus $650 in stock profit, right? Because Apple was at 208.5 and you sold it at 215. Okay. And then the real resets it back to step 1. You sell the 210 put again, collect money, etc. etc. Okay. So that's how the real strategy actually works in a example. Trading the view for me, and it's important that you stick to important rules, right? You don't want to blow up your account. So the first rule is you only want to real stocks that you hold for years. If a stock crashes 40% and you get a sign, you are sitting on a paper loss, right? The only way to recover is to keep selling covered calls and wait for recovery. And that only works if you believe in the company, right? If you sell a cash secured put on a very speculative name, or you sell it on something that you have no conviction in, you're just chasing premiums, then you'll be very careful because you can be left back holding. The second rule is sell at meaningful delta, sell the right delta. So delta is basically the probability of getting assigned. A 0.25 delta essentially means that this option has roughly 25% chance of finishing below your strike. So you want to sell a delta between 0.2 to 0.3, right? So you have about 70% chance of getting assigned. In terms of DTE, that means day to expiration. That means you want to sell at the expiry date. And typically for me, I like to sell within 30 days to 45 days, right? Because there's many um, research that shows that options decay fastest in the final 30 to 45 days, right? So that is using 30 to 45 DTE for me is in the sweet spot. Of course, some people want to do it on a weekly basis, and there's nothing wrong with that as well. Rule number 4 is where, a lot of times people don't lock in the gains, right? So let's say you sell a premium and the premium you collected is 150. If you're already up at 50% profit, you know, you can just close the position. There's no need for you to wait and risk getting a sign, right? You don't want to have a late reversal wiping out your profits. So, when you're at 50%, 60%, just feel free to close it because you're already winning, right? Ultimately, you want to lock in the gains. Of course, if let's say the stock is really trading at the very, very cheap valuation and you don't mind getting a sign and paying out the cash, then go ahead and collect the full premium. But typically, I would close the position around 50 to 70%. Rule number 5 is very important. And this one is, I got to emphasize is make sure that you have the cash to buy the 100 shares. Do not, at least for beginners, at least for people who are new to this, do not sell naked puts, right? Do not over leverage because if let's say the stock dramatically falls down, you're gonna get stressed out because you don't have the cash to secure the put, right? And you might have to sell the the option for a very big loss, right? So don't break this rule, right? Make sure that you have the cash to secure it. So for me, this is my personal preference, right? For me, picking the right stocks is important. The one that you want to do that is real friendly is things that are like your SPY QQQ, which is diversified ETFs. There's strong liquidity. You have big names like Apple, Microsoft, Coca-Cola, JP Morgan, Nvidia. These are, very, very, in my mind, safer stocks to do the real strategy on. Of course, the caveat over here is that if you were going to trade Microsoft or you're going to trade Apple, you need a huge amount of capital. And I know that it's not easy, like 21,000, 30,000, right? So if for smaller accounts, you want to look at, some stocks that are a bit smaller in price, maybe let's say around the $50 range, or you might want to do selling of credit spreads, which I can cover in another video. Stocks that you want to definitely avoid is where meme stocks, right? GME, GameStop, AMC, it's very unpredictable, right? So don't do cash secure puts covered calls on these stocks, right? Early stage biotech, any FDA events can just blow these stocks in half overnight. Uh, Crypto related stocks depends, right? But to me, crypto related stocks is not consistent, right? I think if you look at MSTR and BMNR, over the last few months, they have been in a very, very huge decline. I know people who sell MSTR puts at like $200 plus. Now MSTR is only is only 100 plus. They're left back holding, right? So I would say to avoid this. Okay. Um, okay, earnings, right? This is really dependent. If you really believe in the stock, you can sell a cash secured put on earnings, right? And it can pay, right? For example, I think recently Oracle reported good earnings. Price went up, and basically you get a lot of profits from the cash secured put, right? But in general, I don't really like to sell cash secured puts on stocks that have earnings, just because there's a lot of implied volatility crush, right? So I normally like to sell it after the earnings has been announced. Penny stocks, of course, don't do it. And any stocks you hate, right? So some stocks that you don't want to hold that is in your block list or blacklisted stocks, don't do the real strategy on it. Okay. So always ask yourself when you do the real strategies, will I hold this stock for 1 year, 2 year, 3 year, 4 year, even 5 years? Right? If I am okay to hold the stock for 5 years, and I believe that the fair value of the stock is much higher than what the current share price is, go ahead to sell it. Okay. So the view isn't risk free, right? So there are some things that can go wrong with the real strategy. And that's important to look at how to manage that, right? And the first thing that can go wrong is that the stock crashes hard after you are assigned. So if you own 100 shares and the stocks keeps falling, you can, be caught back holding, right? So this is where you need to be patient. You might need to sell covered calls below your cost basis depending in. And that's why you only want to view real quality stocks, because these are the ones that can recover in the long term. Okay. Second risk is you miss a big rally. And this is the trade-off of covered calls. So let's say if Apple runs from $210 to $250, but you sold a covered call at 215. So your shares will get called away at 215. So you essentially miss the extra $35. But you need to accept this, right? Because this is not a get rich scheme. You're here to generate income, right? It's an income strategy. The third risk is low volatility. So when the VIX is very low, let's say the VIX is like trading at 10, 15, the premium is very small. So you can still run the wheel, but the returns are not very impressive. Currently, with the current conflict and the Iran war, VIX is pretty high, 25 to 30. This is the period of time you want to sell cash secured puts, because you can go quite out of the money and you can still get very decent premiums, right? So if the VIX is very low, you might want to accept a smaller income, or you might just want to sit on the sidelines. The fourth risk is, if let's say the stock you're assigned drops significantly, you can be holding it for months or even years, right? So for me, the solution is always to keep selling covered calls at a strike that will let you exit at your cost basis. Premiums collected month after month can essentially lower your cost basis over time. Okay, so this is it. What are the to wrap it up? I just want to cover the key takeaways. So number one, the real strategy is where you sell a put, you get assigned, and you own the stock. Then you sell covered calls until your shares get caught away, and then you rinse and repeat. So three income streams from one stock. Second, only real stocks that you like to hold for years. Quality first, right? Avoid all those meme stocks. Just do it on tickers that you are comfortable with. Number three, sell at zero point 0.2 to zero point 0.3 delta and use 30 to 45 days to expiration. Close at 50 to 60% profit. Right? This is where you be consistent. Don't get overly greedy. Number four is you want to target 15 to 20% annual returns. That is quite conservative to me. Okay. If you have a $20,000 capital, that's 3 to 4K per year in option premium. And 50 to 20% is pretty reasonable. And it beats a lot of like a lot of like what do you call fixed deposit accounts and high yield accounts, money market funds, right? Of course, some people are very, very aggressive. They aim for like 40% annual returns. To me, that is, I mean, it's a little bit on the high side. I would challenge them. They are taking quite a lot of risks. Okay. And number five is the wheel is not magic. Stocks go up, they go down, they go up, they go down, right? So stocks can fall. There can be a black swan event. Markets can be volatile. The edge that you have is to collect premiums consistently and keep lowering your cost basis over time, and make sure that you only own stocks that you'll be happy to hold through a downturn. Okay. This strategy is used by institutions, not just retail traders, so it works. All right. So thank you so much, guys. There's many resources out there available. So do look at them. But I just wanted to give a very quick overview of the real strategy because there were a bit of questions on this strategy. Thank you.